Welcome and thank you everyone for tuning in to our latest Economic Outlook report with a focus on economic indicators most impacted by COVID-19. Today's report will have a special emphasis on oil. This conversation is taking place on Wednesday, April 22nd, 2020, and leading today's economic update is Previdary's Chief Economist, Andrew Duguay. Thank you for joining us, Andrew.
Thank you, Nicole. I'm looking forward to today's conversation. We picked a quite relevant topic for this week, talking about oil. As we know, oil prices have done some very interesting things this week. And so being the economist nerd that I am, I wanted to screenshot the Wall Street Journal as I opened it up yesterday and noticed that when you look over the ticker of different prices, we noticed that crude oil prices actually dipped negative. And they were apparently more negative earlier that day because they were already up 87% on the day. This is just a fascinating phenomenon that obviously does not happen very often, but it really has been a long time coming in the oil market. So at first, it started as a decrease in world consumption based off of the shelter in place that started in Asia and then quickly spread to Europe and North America. And what we saw is that world's oil consumption basically fell off a cliff. And normally, producers would react quite swiftly to this, but instead we had that historic spat between Russia and Saudi Arabia, which delayed some of the promised oil cuts. And since then, they have somewhat mended their terms and have committed to decreasing oil by around 10 million barrels per day. However, that's too little, too late. And what we're left with is so much oil that there's nowhere to store it. Storage costs are rising, and we are in a phenomenon that is called super contango. And what that means is that the spot price is significantly lower than the futures market because of the cost of carrying the product when nobody has any room to store oil. And so therefore we saw prices dip negatively. Now, okay, enough of the history lesson. Now let's talk about the winners and losers and how this impacts the US economy in multiple ways. So just highlighting here, some of the winners are going to be some even hard-hit industries are going to see some relief from this, and the fact that airlines, with around 30% of their total expenditures in any given month, are typically fuel costs, and so seeing fuel costs obviously decrease will help airlines. Airlines are beleaguered for a number of other reasons, but at least they come out a winner in this situation. And then also consumers with lower gas prices, fuel costs, energy costs. This is a must-needed net positive for US consumers who still rely relatively heavily on oil, and the fact that oil prices are low and fuel costs are low are certainly good for lowering inflationary expectations, as well as keeping a few extra coins in the American consumers' pockets, which we're going to need right now with unemployment rising rapidly and jobless claims increasing by the millions every week. Logistics companies are also going to benefit because of just the lower transportation costs. Think about trucking companies and the cost of fuel. And then storage companies, both onshore and offshore storage, we've seen demand rise for any sort of storage that can hold oil, barrels of oil, tankers of oil. Due to this glut, the storage companies are winning. And then even looking in the oil sector specifically, downstream channels of oil, and these are particularly the refining companies or most of the chemical companies are going to benefit from a lower input cost, right? And they get their margin by taking that input and then refining it, turning it into something else and moving it downstream. Downstream oil companies tend to benefit from the situation, which is going to be good because due to the global recession, demand is going to be weak. So at least with what little lower volume that a lot of chemical companies are facing, at least they can be facing it with potentially higher margins due to the lower oil prices. And then any sort of high energy impact manufacturing will also be winners. Of course, the losers are very clear cut in this, and that's those that are upstream in the oil industry and those who drill and pipe that oil, and even the integrated oil giants who tend to benefit from both drilling and refining, any exposure to the upstream where you're trying to drill for oil and that drilling costs money, you're impacted by this. And we realize, obviously, clearly at negative numbers, which the numbers have returned positive here today, Wednesday, but even at the positive numbers where they are right now, around $9–10 a barrel, nobody's making money. It's still below the cost of production. We're going to talk about that. So then there's the periphery industries. So any sort of areas of the country or the world that are heavily oil dependent on revenues, the extra services in the oil field, or even just servicing those people who work in the oil field. So think about retailers, banks, and etc., are also going to be negatively impacted by this. So we could see pockets of recession-like conditions that are more severe in the United States for areas that are more oil-centric, but also looking globally, those countries that depend heavily on oil are naturally going to be taking a large hit to this. And then we have renewables. Obviously, this is a setback for renewables when the cost of your main competition, it being oil and gas, falls to virtually free. So that'll be a natural setback. Obviously, economic policy could, and environmental policy could certainly help stem some of those losses from renewables, but just in terms of sheer market supply and demand, renewables look a lot less valuable at the moment, given the fact that oil is no longer at its typical $80–100 a barrel, and it is now down to virtually zero. So troubling times in the energy industry. So let's talk about where prices need to be. And so this is our way of starting to look at scenarios for where prices will gradually lift. So obviously I said nobody is making money at $9 a barrel or -$4 a barrel, of course. However, where do prices need to be? It's a little different depending on the country. So I want to take two different views. So first, looking to the right side of the chart, this is countries that are heavily dependent on oil for government revenue. So oil drilling is largely a government activity or heavily subsidized by the government in order to reap the productions and the taxes from that. And these are the OPEC countries, right, traditional ones, and you can also include Venezuela and other countries here in that category. Where do they need to be in order to balance their budget? So this isn't necessarily where they make a profit, but where do they need to be to make enough profit to cover all the expenditures that the government has promised its people? And this is where prices, you can see, really need to be anywhere from $60 to $80 a barrel or more in order for these governments to have a balanced budget. So this is where these governments really need to strive to get oil back up to those type of levels. And that's where levels sat, right, for the last 5 years between this, comfortably in that $60 to $80 a barrel range. That's when OPEC is working and they are controlling supply to meet global demand. Of course, when OPEC fell apart with the Saudi Arabia and Russia spat, we saw that glut start, and now we're seeing obviously no demand for oil as nobody is driving, and the oil prices are much lower than what their target is. Here in the US, our government isn't so dependent on oil as a main source of income in order to subsidize different industries or fuel costs or anything like that. So it's really just about the natural supply and demand metrics for oil drillers themselves. And so here's a couple looks at what it costs to, one, open up new wells, and you can see that ranges anywhere from $40 to $15, $60 a barrel, or just to operate existing wells. And you can even see there that while costs are lower than drilling new wells, just to keep operating existing wells on a break-even basis, we're talking anywhere from $24 per barrel in the Permian to upwards of $38 in offshore and other non-shale areas. So what this means is that nobody in the US is making money at these prices either. Historically, shale has benefited from fluctuating oil prices and has been essentially what has entered into the market as a low-cost provider and turned the United States into the largest oil producer in the world. However, this certain oil environment is not healthy for US oil industry whatsoever. So US is also going to be working, I think, with OPEC and others, and it's in everyone's best interest to try to control this phenomenon and get prices to go back up. When we talk about scenario planning for companies, we want to factor in the fact that oil prices are likely to rise in the future once we get through this global pandemic, once we get through this supply glut, and that both the US and its international oil producing partners are likely going to have to work closer together to make sure that this does not repeat itself. When we do our scenario planning at Previdere, we often include different scenarios for oil prices in our medium, high, and low side scenarios. And this could be everything from a retailer who is selling in Texas, Oklahoma region, which they know that oil prices are going to dictate a certain part of discretionary income that consumers spend in their stores. Or it could be the actual down channel companies that benefit from low oil prices and want to know whether oil is going to stay this low, or is it going to rise back to the historic averages of $60 to $80 a barrel in recent history. So we can build out a few of those scenarios and what if analysis in order to see where revenues might fall in the second half of this year or out into next year based off some different scenarios based off of where we think oil prices are going to be. I think one thing for sure is that oil prices are not likely to remain where they are. It seems there's no incentive for anyone to get there, but oil is a commodity and it needs to be physically stored, and that's part of the reason why oil prices are doing what they are. The other reason I don't think oil prices are going to last too long at this level is because those that have the most to gain from oil prices rising are the ones that really caused oil prices to fall this far. And we talked about this all really started, yes, with the coronavirus health crisis, but also on the supply side with Russia and Saudi Arabia having disagreements and essentially trying to break apart their traditional agreements to curb supply during economic downturns. They have the most to lose as countries as a whole. When we look at projected percent changes of GDP over the course of the next 2-3 years, with oil at simply $30 a barrel, we know it's about a third of that right now, we see that Russia and Saudi Arabia have the most to lose, and then other large oil producing countries also have a lot to lose by prices staying this low. The rest of the world tends to be a net gain from low oil prices. And so when we went over that list of winners, obviously broad segments like transportation and just general consumers and manufacturing, that creates a lot of net winners when oil prices are low, including even in the US, despite it being the largest oil producer in the world and also being a major refiner and manufacturer. It's really a net positive when we look at this for oil in the US. So while oil prices are crashing, we have to take that into context of how much of an economy is actually dependent on oil versus other parts of a diverse global economy. Those countries that are heavily focused on purely oil and use that a lot for their government revenue are going to be losers out of this. And so a lot of countries that are heavily oil producers do have incentive to try to curb production and get prices back up. Thinking about the United States, we've done some analysis and pulled from some analysis from S&P Capital, Deloitte, and others about some things that we're really concerned about in the energy industry in the United States, and particularly that when you look at all the different industry segments in the United States and how they have ramped up their corporate debt since the last recession, energy sector stands out as one of the more vulnerable industries at risk right now, just simply from a corporate debt standpoint. Throw on top of that the fact that oil prices are now at a price so low that the majority, over 80% of producers right now, are not even at their break-even costs. What we have is an energy sector that is highly leveraged at a vulnerable time with oil prices much lower than where they need to be. And this could set up some real long-term damage in the US energy sector in terms of new investment or bankruptcies or just lack of capitalization when we look forward to, is this a temporary thing or is this really some long-term damage? We see some real long-term risk and exposure here in the US energy sector. What we're looking at here are different measures of how leveraged essentially each industry segment is in the United States. And the common themes here, whether we look at the compound annual growth rate in long-term debt or just changes in debt to income ratios, what we see is that the energy sector expanded rapidly from the period of 2010 and forward and increased their debt levels relative to their income, and also even considering the fact that interest rates have been lower, that their interest coverage ratios have been falling. So what this means is that the energy sector has made big bets on the fact that there's plenty of oil out there in the shale areas of the United States, and that the high energy costs were going to make it well worth the extra borrowing and leverage in order to tap those resources. Now that those resources are, I would say, virtually worthless, but very low cost compared to what they originally were, the energy sector sits very vulnerable in terms of industry segments compared to others. When you see other highly leveraged sectors, technology is also one that's up here, as well as healthcare and utilities and communication services. However, each of those industries, as we look at the COVID-19 crisis, are more likely net benefiters, right? People are spending more time on the phone, using remote services, using technology to communicate. Obviously, healthcare should have some benefit from all the effort into trying to come up with a cure and making sure everyone stays healthy. The only real industry out here that has increased its leverage significantly over the past 10 years that is also going to see very strong negative economic ramifications from this business cycle that we're going through right now is the energy sector. And so it's one thing to point out that energy prices are low. It's another thing to say that many of the companies that have participated in the energy sector have borrowed a lot to get here, and we're going to likely see a lot more defaults, cuts in dividends, probably some mergers and acquisitions of vulnerable companies in order to stay alive. So this isn't necessarily the end of oil and gas in the United States, but it's certainly going to be a very interesting time as we move here in the next couple years of how the energy sector is going to retrench from this and resettle and adjust to a new world and get their borrowing costs under control. When we talk about the energy sector or any other sector, we do want to point out that there is a lot of uncertainty, but as Previdary is working with its customers, we are working hard to create accurate, consistent scenarios for planning purposes. And so when we build out our predictive models, we're trying to factor in all the realistic expectations of where oil can go from this very low point, as well as expectations of GDP, retail, and other topics that we've covered in these webinars. So if you want to learn more about Previdary's methodology for how we are forecasting planning for the second half of the year and for 2021 for our customers, please reach out to me or Nicole for more information.
Thank you, Andrew, for the informative presentation. I don't think any of us thought we'd be sitting here talking about negative oil prices. That concludes this economic update for Wednesday, April 22nd, 2020. Our thoughts are with all of you and your families, as well as the many scientists and healthcare providers through the pandemic crisis. Stay tuned for ongoing announcements as we'll be following up with updates as they are developing. And if you have any questions, feel free to reach out to us.